You are listening to the Vocal Technologist. Spoken tech for your ears.
I was sitting there the other day thinking about how, for decades, science fiction sold us this very specific nightmare about the singularity. We were promised Terminators. We expected Skynet to kick down the door and demand the nuclear launch codes. We thought the rise of the machines would be this, this visceral, physical confrontation.
Right, and instead we got something much quieter, didn't we?
Exactly. It turns out the robots did not want the nukes. They just wanted our bank accounts.
Which, if you think about how our society is structured, might actually be way more dangerous, or at least more disruptive.
Too right. You are tuned in to the Vocal Technologist. We are unpacking the messy, fascinating convergence of money, code, and that strange gray area where they start to look like the exact same thing.
It is a massive convergence. I mean, we are looking at a world where AI agents are getting their own credit cards, social media giants are effectively morphing into banks, and the traditional financial institutions are quietly buying up the decentralized infrastructure.
It is heaps to process. The information we are looking at suggests we are moving past the era of DeFi, or decentralized finance, into something new. The term neo-fi keeps popping up.
Neo-finance, yeah, it is a really useful distinction.
So let us break that down. Neo-finance is not just crypto for the sake of crypto. It is where the lines blur completely between the old world and the new. And to kick this off, we have to look at the biggest social graph on the planet, finally waking up to the reality of digital currency. We are talking about Meta.
This is a huge signal. For a long time, Meta has been trying to figure out its finance play. You remember the Libra project?
Oh, man, I remember. Zuckerberg went to Congress, and the regulators absolutely tore it apart.
Spot on. They tried to build their own currency from scratch, and the world essentially said no. So they have pivoted. The big news now is that Meta is prepping to integrate stablecoins, specifically USDC and USDT, directly into their ecosystem.
Right.
Facebook, Instagram, WhatsApp. The target is to have this live by late 2026.
I want to pause on the scale of that for a second. We are not talking about a niche crypto wallet for tech enthusiasts. We are talking about 3 billion users.
Precisely. This is the big difference between crypto and fintech. This is your aunt on Facebook or a local business running entirely on WhatsApp suddenly having access to dollar-pegged digital currency. They do not need to know how a blockchain works.
They just need to know the money arrives instantly.
Exactly. And the mechanism they are using is super interesting. They are partnering with Stripe and a company called Bridge.
Bridge. That is the acquisition Stripe made recently, right?
That is the one. And that acquisition is really the key to this whole neo-finance concept. Bridge essentially allows businesses to launch stablecoin card programs. So Meta is not building a new currency anymore. They are building a pipe.
Connecting the crypto world to the existing credit card and banking rails that Stripe has already mastered.
Yes.
It feels like a direct shot at X and Telegram, does it not? I mean, Telegram's been moving incredibly fast with crypto integration, but Meta just has this sheer weight of numbers.
It is absolutely a platform war. But what is fascinating here is the underlying trend. We call it neo-finance because it is no longer about pure protocols living in isolation. It is about products that bridge on-chain and off-chain systems. The stats really back this up. B2B stablecoin payments grew 733% year over year.
That is an insane number, 733%. That is not growth, that is a vertical line.
It is, and this leads us to a really important concept that explains why this is happening. It is called Jevons paradox.
Okay, let us unpack this. Jevons paradox. It sounds like a spy thriller, but I gather it is economic theory.
It is, from the 19th century, actually. The basic idea is that as technology increases the efficiency with which a resource is used, the total consumption of that resource increases rather than decreases.
So counterintuitively, if cars get more fuel efficient, we do not use less petrol. We just drive way more because it becomes cheaper to do so.
Spot on. You stop rationing the driving, and Jevons paradox is coming for finance. Right now, traditional finance is incredibly inefficient. In North America alone, the industry spends about $61 billion annually just on compliance. It is slow, it is expensive, and it is filled with friction.
And stablecoins collapse that cost.
They collapse it to near zero. So the paradox suggests that by making payments incredibly cheap and instant, we will not just replace the old payments, we will massively expand the total volume of financial services. Think about M-Pesa in Africa or UPI in India.
Right. When you lower the barrier, you do not just get the same activity for less money, you get entirely new types of economic activity.
Yes.
Like microtransactions, they were previously impossible because the fees were too high. You could not send 50 cents across a border if it cost you $10 in wire fees. But with stablecoins, you can.
Yeah, or global payments settled in seconds. JP Morgan has a system called Kinexys, processing $2 billion daily. We are seeing the settlement time go from days to seconds. That is the NeoFi promise, expanding the pie.
Speaking of expanding the pie, let us pivot to who or what is going to be doing a lot of this spending. Because based on the research, it might not be humans.
This is where it gets really sci-fi. We are entering the era of agentic finance.
Agentic finance.
Yeah.
I love the term. It sounds like the machines are getting organized.
Essentially, they are. The idea is that non-human entities, AI agents, are becoming economic actors. We are seeing software layers now, like MoonPay agents, that are specifically designed to give AI agents their own wallets.
So let me get this straight.
Okay.
I can have an AI assistant, and I do not just give it a command like book me a flight. I give it a budget.
You give it a wallet. MoonPay agents, for example, allows these bots to fund themselves using Apple Pay, PayPal, or Venmo. They can trade, they can manage portfolios, and they can execute transactions autonomously.
That is wild. So the AI can decide, hey, the market is dipping, I am going to buy, and it just does it. No confirm button for me to press.
If you set the permissions that way, yes. There is a protocol called BY402, which is gaining traction for payments, and another called ERC8004 for identity. BY402 has already surpassed 15 million transactions.
15 million. That is not a pilot program. That is real volume.
It is significant. And look at what DFlow is doing. They launched an MCP server that stands for Model Context Protocol. It allows agents to read APIs and execute trades without human help. It replaces the need for a human to code the integration. The agent reads the documentation, understands the API, and starts trading straight away.
Okay, but being the skeptic here, this raises so many questions. If my AI agent goes rogue and drains my wallet on a bad meme coin bet, who is liable? Or if it accidentally crashes a market?
That is the legal frontier we are standing on. We are effectively creating a financial system for non-humans. It is comparable to the 19th century when we invented the Limited Liability Corporation, or LLC.
How so?
Well, think about business before the LLC. If a business failed, the owner was personally ruined. They lost their house, everything. The LLC created a corporate person, a legal entity that could own property, sue, get sued, and go bankrupt without destroying the human behind it. We might need a similar structure for AI, an LLC for bots, if you will.
A limited liability computer.
Something like that. Because if an AI causes harm or breaks the law or loses money, the liability chain is currently undefined. Vitalik Buterin has actually warned about this.
The founder of Ethereum.
The same. He has been skeptical of this vision of Web 4 where we just let the AIs run everything. He argues we must keep humans in the feedback loop to avoid anti-human outcomes. If the incentives are purely algorithmic, an AI might optimize for profit in ways that are disastrous for people.
Like selling off a hospital's assets because the algorithm noticed the land value went up, and it did not understand that a hospital is a social good, not just a balance sheet entry.
Exactly. Efficient, profitable, and socially terrible.
It is a brave new world.
Yeah.
But while the robots are getting their wallets, the suits on Wall Street are not sitting on their hands. We have seen a massive shift in the institutional side, particularly in the U.S.
We have, and it starts with regulation. There is a piece of legislation, the Promoting Innovation and Blockchain Development Act of 2026, which is really changing the game for open source developers, protecting them from liability. But the bigger news for the banks is the SEC's new guidance.
This is the capital rule change, right?
Correct. The SEC now allows broker-dealers to count stablecoins as regulatory capital with only a 2% haircut.
Okay, hold on. Haircut is one of those banking terms that sounds harmless but means something specific. For the listeners who do not speak bank regulator, why does that matter?
It is huge. In banking, a haircut is the percentage of an asset's value that is deducted for safety when calculating capital. If you hold Bitcoin, which is volatile, the haircut is massive. You have to hold almost dollar for dollar cash against it to be safe. It makes holding it expensive.
Right.
By saying stablecoins only need a 2% haircut, the SEC is effectively treating digital dollars almost like cash. It removes a massive barrier for traditional firms to hold crypto on their balance sheets.
So it is the green light for them to actually use this stuff without being penalized.
And they are using it, or rather they are buying the infrastructure. We are seeing major players like BlackRock, Citadel Securities, Apollo Global Management buying up DeFi tokens.
Like BlackRock is buying governance tokens? Like you and I.
They are. BlackRock buying UNI, Citadel buying ZRO, Apollo buying more hay.
That seems odd. Are they speculating? Are they becoming degens hoping for a moonshot?
No, and this is the critical distinction. This is vendor alignment. They are not buying these tokens hoping they go to the moon. They are buying them because they plan to use these protocols as the rails for their own tokenized products.
Ah, I see. So if you were going to run $1 billion of tokenized assets through a protocol, you want to say in how that protocol is run.
Exactly. You want a seat at the table. You need to own the governance tokens to ensure the protocol evolves in a way that suits your institutional needs. It is a strategic infrastructure play, not a gamble.
It makes sense. If you are building a railroad, you want to own shares in the steel company so they do not stop making rails.
Perfectly put. They are securing their supply chain.
So we have the tech giants, the robots, and the banks all moving in. But what about the actual assets? What are we actually trading on these new rails?
Real-world assets. This is one of the hottest sectors right now.
I thought the news about Grant Cardone. He is the real estate guy, right? Big personality, lots of shouting.
Very big personality. And he is planning to tokenize a $5 billion real estate portfolio.
That is a lot of apartments.
It is. And the goal is liquidity. Real estate is notoriously illiquid. You cannot sell one brick of a building if you need cash. You have to sell the whole building, which takes months. Tokenization allows you to sell fractions of the portfolio instantly.
It turns a building into a stock, essentially.
And speaking of stocks, Kraken has made a major move here. They have launched perpetual futures for tokenized U.S. stocks. We were talking Apple, Tesla, NVIDIA.
Now, perpetual futures or perps is a very crypto-specific term. We should define that for you if you're listening.
We should. In crypto, a perp is a contract that lets you bet on the price of something without an expiry date. In traditional futures, the contract expires every month or quarter. With a perp, you can hold it as long as you can afford the funding rate. Kraken is applying this crypto-native model to traditional equities.
So I can trade Tesla stock at 3 a.m. on a Sunday.
24/7 trading, regulated. But, and here's the kicker, it is not available for U.S. users.
I love the irony. You have U.S. stocks, iconic American companies, being traded 24/7 by everyone in the world except the people in the U.S.
It highlights the regulatory arbitrage happening right now. The innovation is happening offshore because the U.S. rules, despite the recent thaw we mentioned earlier, are still restrictive for retail investors. But the model is powerful. It is all about access and efficiency.
It is not all smooth sailing, though, is it? We have talked about the shiny new toys, but there is some serious friction in the gears. There is a lawsuit that caught my eye. Terraform Labs versus Jane Street.
This is a blast from the past referencing the Terra Luna collapse of 2022. It is getting messy.
So Terraform Labs, the company behind the failed stablecoin, is suing Jane Street, which is a massive quantitative trading firm. What is the actual allegation?
They are alleging insider trading. Terraform claims Jane Street used non-public information to front-run trades. Essentially, they're saying Jane Street knew the collapse was coming or helped trigger it and profited massively while everyone else lost their shirts.
That is a heavy accusation.
It is the dark side of this convergence. When you have sophisticated institutional players entering an unregulated or semi-regulated market, the potential for information asymmetry is huge. It is not a level playing field.
It reminds us that while the tech is new, greed is very old.
Indeed. But alongside the lawsuits, the technology itself is trying to fix its own bottlenecks. We have to talk about the roadmap, Ethereum specifically, and the delightfully named straw map.
Why straw map?
It is a draft roadmap, a straw man proposal. The big goal here is speed. They want to reduce finality.
Again, define finality for us. It is not just transaction speed.
Right. Speed is how fast the transaction happens. Finality is how long until that transaction is irreversible, when it is mathematically impossible to undo. Currently on Ethereum, that takes about 15 minutes. They want to get it down to roughly 6 to 16 seconds.
That is a massive jump. 15 minutes is an eternity in high-frequency finance. 6 seconds is credit card speed.
It is necessary if they want to compete with the likes of Visa or even faster blockchains like Solana. The strategy is a dual track. The base layer gets faster while layer 2 networks handle specific tasks.
And one of those specific tasks is privacy.
Crucially, institutional adoption requires privacy. If BlackRock is trading billions, they do not want the entire world seeing their wallet address on Etherscan. We are seeing a rise in confidential transactions. Starknet has something called Strike BTC, and Near is launching a private mode.
It is funny, is it not? crypto started with Bitcoin, which is a public ledger. Transparency was the feature. Now to get the big money in, we are building walls to hide the transactions again.
It is the cycle of maturity. Total transparency is great for accountability, but terrible for business strategy. You cannot negotiate a deal or execute a large trade if everyone sees your hand before you play it.
So let us try to pull all these threads together. We have Meta putting stablecoins in WhatsApp. We have AI agents with their own debit cards. We have banks buying governance tokens to control the rails. And we have real estate turning into liquid tokens.
It is a pincer
A
movement.
pincer movement.
Think about it. You have AI agents pushing from the bottom up. They are going to generate billions of microtransactions, creating a high-volume, low-value economy. And then you have the institutions pushing from the top down. They are bringing tokenized capital, high-value, regulated assets.
And we, the users, are stuck in the middle.
Or liberated by it, depending on how you look at it.
This brings us to a really provocative thought to leave you with. We are staring down 3 potential futures.
Right. 3 distinct paths. Option 1 is TradFi absorption. The banks just eat crypto. It becomes a back-end efficiency tool for Wall Street, and nothing really changes for you and me, except maybe payments are slightly faster.
Which is convenient, but kind of boring. What is option 2?
Government surrender. The permissionless systems become so powerful that governments just give up and accept a parallel, uncontrollable economy. That seems pretty unlikely.
Yeah, governments generally like being in charge. And option 3?
The golden path. A parallel system. An uneasy coexistence. You have the convenience of NeoFi. Your bank account on a blockchain, easy, compliant, safe. But you also maintain the ability to opt out. You keep the sovereignty of the original crypto mission, holding your own keys, privacy tools, censorship resistance.
So the challenge for you listening is to decide which lane you want to drive in. Do you want the convenience or do you want the sovereignty? Because as NeoFi grows, the convenient option is going to get very, very attractive. It will be seamless. It will be integrated into your social media and your AI assistant. You will not even notice you were using it.
But the cost of that convenience is relying on Meta or Stripe or BlackRock. You are trusting them not to deplatform you.
Whereas the sovereign path requires actual effort. It requires managing your keys, understanding the risks, navigating the friction. It asks way more of you.
It is the classic struggle. Comfort versus freedom.
And for the first time, we have valid, scalable technologies for both sides operating in the exact same space.
We do.
Well, that is heaps to chew on. The robots are trading, the banks are coding, and the real estate is liquid. It's a wild time to be watching the wallets.
It certainly is.
We're going to wrap it up there. Keep an eye on your AI agent and make sure it is not spending your retirement fund on dog coins.
And read the terms of service.
Always. Stay curious, stay skeptical, and catch you next time.
Spoken Tech for your ears.